Hi, Loren Keim here with Lehigh University's Goodman Center for Real Estate. We're live today with quite a few tuned in, and we're going to talk about the risks and rewards of real estate development, particularly commercial investment real estate development, and particularly in a post-COVID world. Today, we have with us Peter Polt, who's the Executive Vice President of Petrucci Development, a great company that does development all over Eastern Pennsylvania and New Jersey, anything outside of the Manhattan marketplace. And while they've done every type of real estate development, they have particularly developed literally hundreds of warehouse, distribution, and flex buildings and flex projects in that entire region. And as a developer, they start with raw ground, they obtain entitlements, they build out the projects. So again, I'd like to introduce Peter Polt, who incidentally also did receive his MBA from Lehigh University. Thanks for joining us today, Peter.
Well, thanks for the opportunity. My name is Peter Polt. As Loren indicated, I'm an executive vice president with JG Petrucci. I've been with the company going on 14 years, basically from the time I finished up my MBA at Lehigh, and have spent quite a bit of time in the iReal program, both as a graduate student and afterwards. Teaching every so often to this class. Typically, what I like to do in these presentations is I'd really like to try to make it more interactive and just not myself speaking to you. But I'll give you a little background on what our company does, and then I always like to kind of share how we look at investments, because depending if you're looking to get into the real estate industry, there's so many different avenues you can go down. The development side is very different than potentially getting into brokerage or capital markets versus going to work for a large investment fund that specializes in real estate assets. So they're all very different aspects. And I've played in all aspects of that. But I thought I'd give you kind of an outlook on how we do things here at JG Petrucci, which is pretty unique, I think, to how we create value for ourselves and the investments that we put together. So just briefly on who we are. The company was founded by Jim Petrucci in 1987. We're in our 34th year. Honestly, the stats that you see here does not do us justice because we've done a lot more than what this says. But our company is really founded on a design, build, development philosophy, which I'll discuss in more detail. But in general, we have really two main business lines. One is or the design build side, where we do a lot of third-party construction on a design build basis. The theory being that our construction team is comprised of engineers and architects and construction project managers that work with the design team and our clients up front to develop the most cost-efficient facilities to meet their needs. And we've completed over 700 projects under that manner. But the other side of our business is really the development arm, which I sit in, which is really focused on our own investments and portfolio building. And we focus mostly on industrial and multifamily development, which luckily has played very well during the pandemic. And we'll discuss this in more detail. We do have a little bit of retail and a little bit of office, but our primary focus has been ground up development of multifamily and industrial. And we own about 2,000 apartment units. We have our own residential management company, which I run. And we own about 4.5 million square feet of industrial, but we're in the process of developing currently about 4 million square feet right now, which is more for institutional clients. where we're partnering with them on very large scale projects on buildings averaging between 500,000 square feet and 1.5 million square feet. It's a really interesting time, and we'll talk a little bit more about what we're seeing in the economy right now, and how it's impacting the real estate market in a little bit. I think I touched upon this pretty well. One of our big focuses is we're really not greenfield developers, meaning going out, finding farmland and developing it. At least that's been our history. Right now, we're doing a little bit more of it as a demand for big box warehouse distribution facilities is at an all-time high. But our focuses really have been urban infill, adaptive reuse, redevelopment projects. We've done a lot of work in the city of Bethlehem, in the Lehigh Valley industrial parks. We have a lot of big projects in East Orange and Newark and Plainfield, as well as the suburban Philadelphia markets. And our specialty really is focusing on brownfield redevelopment. So this next segment, what I really wanted to talk about is how we at Petrucci in general are focusing on investments. I think it's important as students when you come out, and if you're focusing on real estate, to understand the various aspects of what fields you can get into. For me, my focus has been on the development side, but as I said, you can focus on many other forms of the real estate industry, whether it's on the brokerage side, capital markets. That's been a very fast growing field as you start to see some of the big conglomerates like CBRE and Cushman Wakefield and JLL continue to try to become more vertically integrated, providing additional services to their clients, and just the overall sophistication of the real estate industry. When I started, over 15 years ago, industrial was a very not a very popular field, and wasn't really thought of, very highly in the real estate investment market. There were very few groups doing it, especially on the institutional level. And probably over the last 5 to 10 years, as e-commerce has continued to expand rapidly, especially during the pandemic, these institutional groups and funds are desperate to get into the industrial market. The industrial market in just New Jersey and Eastern Pennsylvania probably has almost tripled over the last 7 years in terms of supply. And when you think about that, the Lehigh Valley market, when I started 15 years ago, was maybe 25, 30 million. It's approaching 100 million square feet alone in warehouse development. That is an astronomical gain over the 15 years. And when you think about these projects taking, from the time you find the land to getting it approved, to building it, to getting it stabilized, 2 to 3 years at best. So to see that much development going on and most of it being speculative, and seeing that the tenant demand for this space has really changed the way the investment market and institutional groups have valued industrial. They're basically retreating from office and retail and getting into industrial, and they will pay anything it takes to get into these core markets, which for us, New Jersey and Eastern PA, as one market segment, is considered probably the second largest industrial market in the country outside of the Inland Empire in California. The other sides of these businesses outside of development, from the institutional side, you're much more looking at investment funds, portfolio management, which is much more of a financing background than development, right? These groups are very risk adverse focused on really returns for their funds. So they're partnering with developers at various points in a project to develop and acquire these buildings and build large portfolios. And a lot of these groups are focusing on deal acquisition sizes north of $50 million, which when you look at a warehouse building, depending on what market you're in, to place $50 million in a warehouse deal, you're talking about large warehouse facilities, probably north of 500,000 square feet. Could be a little bit smaller depending on the various market segments in New Jersey. But to place $50 million, you're talking about a very big warehouse project. Our history, in terms of where JG Petrucci fits in this, is we're much of a smaller, more what I call light industrial manufacturing developer. Most of our buildings average anywhere from 50 to 250,000 square feet. And we've found a very nice sweet spot in that market because the demand for that space from a user perspective, meaning the end tenant, is very high. But you're not seeing a lot of developers and institutional groups focusing on those assets, which helps us not have to compete against very inexpensive money, right? I mean, most of you probably have taken some financing degrees or financing courses. So looking at cost of capital, right, where these funds, maybe their cost of capital is significantly less than a private developer, where we're looking to make a much higher return. Funds maybe are looking to produce, maybe low single digit returns, where for us, we're looking to maximize our returns. We don't have the resources or the funds that these big institutional groups have, which is averaging probably well over $1 billion, right? So for us, we've kind of focused on a middle market as our core portfolio strategy, and while also trying to capitalize on this crazy industrial demand. So, we are a New Jersey and Eastern Pennsylvania centric group. We've developed unbelievable relationships over our 34 years in business. We're able to find deals that a lot of the bigger institutional, more national groups can't find. So relationships with farmers, with municipalities, with local brokers. So we can unmine deals that a lot of groups don't see. So even though our core business is really focused on smaller light industrial, we have built a very big, what I call institutional joint venture partnerships, where now we're developing, about 4 million square feet for those groups, where we take a more mitigated risk position of 5 or 10% in a deal with a lot of upside in waterfall structures. So if these deals get stabilized and pencil out and hit certain investment triggers based off of IRR calculations, we can take our 5 or 10% and increase that to 40% of the deal. So we're mitigating risk. We're capitalizing on our development and construction expertise. And are bringing in institutional money on a 95% basis. So it's been a really interesting 5 years for us to kind of see that dichotomy into these two asset classes and how we're approaching it. So I think that was kind of the long-winded explanation of, business and investment strategy. You have to understand, I think, first and foremost, what is it that you're focusing on? What is your investment strategy? And for industrial, that is our focus. We focus on the smaller um, smaller warehouse facilities, more specialty manufacturing as our core portfolio. And we're taking advantage of a very, very hot, lucrative market to increase our returns as well. We've talked about a little bit, so you understand what your business is. And then you have to kind of marry it up to the economy and where we are. And quite frankly, sitting here a year ago, we were in the process of selecting a partner for about 4 projects totaling close to 1.5 million square feet. As you know, probably in early March of last year, the pandemic hit, which dramatically changed how we did business for the next 3 months. And going through 3 previous recessions, the fear at the time was that with this pandemic hitting and trying to capitalize on institutional investors, our fear was that the capital markets would cease to do business, stop doing business, which they did for 3 or 4 months. And we had to put a lot of projects on hold during that time period. But luckily, our core business remained very strong in terms of the smaller light industrial facilities and kind of carried us through. But then we just saw a massive rush back into the industrial market once everybody figured out that the pandemic was really a tale of 2 stories, where your retail brick and mortar stores, right, shopping malls, retail centers, and office space were being decimated. The continued need for e-commerce really kind of stole the show, which benefited the industrial market. And as companies started to reevaluate supply chain and how to mitigate disruptions from overseas distribution and things like that, the demand for space over, let's just say, the market kind of stopped late Q1 all the way through Q2 of last year. But Q3 and Q4, the amount of product that was absorbed from end users in the industrial market, just in those 2 quarters, outpaced all of 2019. And Amazon and Walmart and Target, Home Depot and FedEx were probably your biggest market movers. Amazon being the biggest market mover. In New Jersey alone, Amazon took about 30 or 40% of the warehouse space available last year, which is just an amazing stat. So, from our side of things, it's been very interesting, even though we're long-term hold developers, to really kind of watch what's happened here over the last 6 months and continues to happen. I would say that the industrial markets, at least for 2021, are considered to be continue to be very strong. Tenant demand is outpacing supply almost 2 to 1, which is requiring these tenants to start looking at if you're looking to be in New Jersey or Eastern PA, they're starting to have to cast a wider net to fulfill their demand. So you're starting to see secondary and tertiary locations in New Jersey and Pennsylvania start to have a more prominent role for industrial market. And it's going to be very interesting because there's just not enough available land and or available product to meet this demand. And the question now is this demand sustainable? How much further can Amazon really go in their model? what happens to retail users, especially groups that are starting to file for bankruptcies and things like that in the apparel industry. What impact does that have on the warehouse market? Will we see a lot of these warehouse facilities start coming back to the market as these groups work through vacancies or bankruptcies? So I don't think anybody has a real firm understanding, but what I can tell you today is that supply is far out, or demand is far outpacing supply. The institutional groups that do not have a lot of industrial in their portfolios are overpaying for these products. So you're just seeing just this insatiable demand for warehouse facilities. Now, we've talked a lot about industrial, but the multifamily side is also a very interesting um, um, business case to look at. We've built our portfolio over the last 10 years. And quite frankly, when the pandemic hit, we're very fearful that the delinquency was going to increase, where our portfolio typically averages well under 1% of delinquent tenants. Our fear in the beginning was that our delinquency would exceed 20-30%. And then what do you do, right? I mean, we have debt on these facilities. How is this all going to play out? How are you going to, how is your management team going to be able to work through this pandemic, right? Because you have maintenance guys that need to get into your units. So it was a very challenging time. And what we did see, at least in our assets, and quite frankly, I would say in New Jersey and Eastern Pennsylvania, that the luxury apartment market remained very strong. Our delinquency maybe ticked up to about 1.5-2%, which at the end of the day, although it does hurt the bottom line, it wasn't as devastating as we originally thought. And quite frankly, we're still seeing a big demand for multifamily space. And I think that has to do with the markets that we're in, which are very high barrier to entry markets. It's very hard to get these deals developed and built and leased, and the demand for housing in our markets is at an all-time high. So I think luckily the New Jersey and Eastern Pennsylvania markets are pretty well buffered in comparison to maybe the Midwest and some other non-core markets. So, with that, also what we're seeing is with all the demand for warehouse and multifamily space, we're also starting to see a massive spike in the cost for construction materials, especially lumber and steel. And that's something that we're going to have to pay attention to here going forward, because these deals we're building to pretty razor thin margins at this point. And it's going to be harder to build these deals with steel and lumber increasing over 40% in the last 3 months. So no crystal balls here in terms of what the post-pandemic economy looks like. Although we do believe, e-commerce will continue to take market share from bricks and mortar retail. Not 100% sure if the level of activity we're seeing now in terms of users will continue over the next 3 or 4 years or not. But certainly these things are cyclical. We do not expect the amount of new tenant demand for space to continue on a long-term perspective, but it does feel that it will at least continue for the next year or two.
Can I ask you a quick question while you're kind of on
Sure.
that subject? So incidentally, one of the things we are seeing, you were talking about multifamily in Eastern Pennsylvania, New Jersey, that's very strong, but actually across the river into Manhattan, you're seeing that getting softer as many of those people are moving out, which is probably helping this market. But you had mentioned industrial and warehouse being sold to institutional investors. What kind of cap rate are you looking at in that type of sale at the moment? What are you seeing?
It's great. That's a great question. It depends. So I would say anything in New Jersey along the 95 corridor.
Mhm.
So New Jersey, the industrial market in New Jersey is split into the north, central. So north is considered basically Newark and up north. Central is basically Newark down to it keeps expanding, but down into Edison, Carteret, and then South Jersey was always considered more like the Lehigh Valley. Deals just weren't really going there. But the southern New Jersey market has now increased as well. So I would say in northern and central New Jersey, stabilized deals, meaning tenants in place in buildings, are trading at a 3.5 to 3.75 cap.
That's insane. Absolutely
A
insane.
lot of that. So a lot of that is because the demand from institutional investors to get into the space.
Yeah.
Number one. Number two, it's based off of current rents, but these institutional groups are looking at trending rents. So, if you signed a deal in North Jersey last year, let's say you're somewhere between $10 and $12, those deals today are $14 to $16. So a lot of these institutional groups believe that even though you're buying this asset at a really low cap rate, they also believe there's a lot of rent growth and there will be continued rent growth just because of how e-commerce has changed, right? And the pandemic is a big reason for that. There no doubt that we will continue to use um, e-commerce in how we buy and consume goods, um, and the belief is that that's only going to increase over time. South Jersey assets are trading probably at 4.25 cap, and that's where the Lehigh Valley is, probably 4.25 cap to 4.5 cap, and I'm talking about Class A industrial. Obviously, if you get into B, C type facilities, very different cap rates. But it is crazy. Rents are increasing probably 7 to 8% on average a year right now, just because there's no space and the demand from tenants is outpacing the supply. But we do believe that there's going to be continued rental growth here, and interest rates appear to appear that they'll stay low for the foreseeable future. But these cap rates are crazy. Now, when the market changes, if the rent growth, if you don't see this rent growth and interest rates creep up, you could see very quickly how these institutional groups that are paying 3.5, 3.75 cap rates are going to be underwater pretty quickly. So it'll be interesting to see what happens here over the next 5 years. But from our side, the Petrucci side, we're not paying those cap rates. We're hopefully getting projects, finding land, entitling it, and bringing in institutional groups willing to pay that and take our position out at the end of the deal. So
do that with the Frappuccino. One of those two.
I'm sorry, was that somebody asking a question? Okay. Sorry. And then on the multifamily side, it is interesting because New York is always kind of the first indicator of a softening in the market. And certainly multifamily is really hurting in New York. The question is it's definitely, the pandemic is a big part of that, right? Because the benefits of being in New York is for living in New York is having just really the world at your fingertips, and not being able to go to restaurants or museums or concerts or whatever it might be, and living in a very, small space is really not ideal. And most of the offices are shut down or working on skeleton crews, so you can work almost anywhere you want in the entire world. So most people are temporarily moving out. The question will be, when do people start going back to the city, and how long does it take? I know we spent a lot of time, and it's already 11:15. So just kind of working through. So we talked a lot about development issues, right? And we've, talked about supply, demand, risk versus return. Entitlement issues continue to be really tough. Townships and municipalities have had enough of warehouse. I call it the warehouse fatigue. The infrastructure is just not there to support the fast growing demand for warehouse space. So we are in a market where we're in high barrier to entry market, where it's hard to get these deals done, find the land, get it approved, and get it built, which has only benefited the value of quite frankly, the multifamily and industrial markets. So these are all development items that you have to consider when you're on the development side of the business. The other side of this, that when you get into the development side, obviously it's a very different model than when you're just looking at from a fund management side, right? Where you're just looking at cash flows, looking at exit strategies, looking at your IRR. From the development side, you have to be able to look at all the aspects of the development process in terms of what is the land cost, how much is it going to cost, and how much time is it going to take to get it designed and approved. What about construction costs? How does financing fit into this? Where are interest rates? Where do I think lease rates are? What do I think the value of the project is from a cap rate perspective? And quite frankly, we're in a time right now where it's very volatile. The industrial market for probably a good 20 years was a very stable market. You knew what the rents were; they weren't changing much. Kind of knew where construction costs were. Land values weren't changing. Cap rates were pretty stabilized. But now you've just added all of this fuel to the fire in terms of fast growing rents. Land values have gone up exponentially. Cap rates continue to compress. So it's really hard to be able to take all of the cost side of this, figure out where your rents and valuations are, and determine if it's worth doing. This is not a sustainable market for sure. The question is, does it go for a few more years? Which I think there's a pretty good case to be made that it will. And then you got to put this cost benefit analysis together. So you have to figure out from the developer side, how much. We don't have unlimited funds. So we have to make decisions on where we're placing our money. The multifamily side is more of what we call kind of a get rich slow business, where you're leaving a lot of capital in these deals, but they're a little bit more recession proof, and continue to increase in value over time. Whereas if you take a much more speculative position on buying land for a big warehouse facility that might take you 2 to 3 years to get approved, and you're sinking, $1 million or $2 million into that process without buying the land, if the market changes, you could have a very, very, very big loss. So these are all things that we're contemplating as we work through this. through evaluating each deal. And depending on what side of the business you come into, the development side is the most risk, right? Whereas the institutional side is less risk because you're already buying a stabilized asset where the developer is being more speculative in their investments. But with that risk also comes a higher return. I was going to walk through a couple projects, but are there any questions? Anything? Do any of the students have any questions that they would like to ask at this time?
I have a quick question.
Sure.
You talked about like the high barriers to entry,
Mhm.
and spoke about like a variety of factors as to why that's the case.
Sure.
Is there something that you could like pinpoint as to like the main driving factor for that high barrier, or is it kind of just a mix of all of them together?
Well, I think it's a great question. So what if we just focus, let's just focus on industrial because it's a little bit easier to understand and the market is not as small as multifamily, right? Because multifamily, you have very different regions, right? Where really the warehouse market for New Jersey is north central and southern New Jersey along the 95 corridor, and then extending out 78 as you would if you're heading to Lehigh from New Jersey. You take 78 out, the 78 corridor, and that's the Lehigh Valley industrial market is kind of centered around the 78 corridor. So the high barrier to entry market is number one, both the Lehigh Valley and New Jersey had a very big industrial market to begin with. So the land that the additional land, available land that is zoned appropriately and located in good locations with quick access to 78 or 95 or major highways, it was low to begin with. So you've seen as the user demand has spiked here over the last 5 years or so, you've seen the developers try to find good industrial space, and there's just not a lot left. And so a lot of that was absorbed, over the last few years, and the demand, especially with e-commerce, continues to increase exponentially. So there's just not a lot of land left, and these municipalities are really cracking down. They're changing their zoning ordinances. They're changing, the criteria for warehousing, and there's just not a lot of good land left to begin with. So, it's going to continue to be hard to find good space, and developers are starting to change. Start looking at old office buildings that they can knock down, old malls, things like that, to try to find scale, to build to.
Great, thanks.
Thanks. Any other questions?
I was just kind of curious, like what the old cap rate used to be for these kind of buildings. Like,
That's a great question. So 15 years ago, we wouldn't touch a project unless it was an 8 cap. And we were hoping to sell it for maybe a 7 cap, maybe a 6.5 cap. So, I mean, this cap rate compression is crazy. So if you just do the math, I don't have my calculator in front of me. Hold on. But let's just say you're at a $5 rent, right? 15 years ago, and you thought the value was a 6.5 cap. So $5 divided by 0.065 was like a $77 per square foot value on a building. Well, let's just say you keep a $5 rent, which is not the case today. But if you did that on a 4.25 cap today, that's $117. So you just made $40 a square foot more just by cap rates compressing. But now if the Lehigh Valley market was $5, 15 years ago, it's $7 today. So if you do $7 divided by 4.25 cap, that's $164.
And actually, just to add into that, one of the things you have to keep in mind, if you're buying it at a 3.5 cap today, if the cap rate goes up to 7%, the value is effectively cut in half. So if the income is exactly the same, if you're paying $1 million for a building today at a 3.5 cap, and that cap for whatever reason next year jumps to 7, and you're at the same income level, that building is now worth $500,000, according to how investors buy it based on the cap rate.
Yeah. Yeah, and that cap rate, I mean, there, I always say it's more of an art than a science. It reflects risk, but it also reflects where interest rates are. And we've been in a very low interest rate environment. And the question is always, what happens when interest rates start to creep up? So it is hard. Our investment philosophy, we would never pay, 3.5 cap or 4 cap. We're still trying to find. We always try to underwrite 200 to 300 basis points of value into a deal. So if we think the cap rate, the exit cap rate's 4.25, we're trying to be at, 6.25 to 7.25, which is hard to do. I mean, these deals are hard to find now, but at least gives you room in the event that the market changes, that you have some risk buffered into the deal.
I kind of have a broader question. I know you guys are based in Pennsylvania and New Jersey, but do you guys ever consider looking at the real estate and like the boroughs of New York City and like moving or looking out there while the real estate or the supply in New Jersey and Pennsylvania is slow?
That's great. It's a great question. We do, we always kind of try to expand our market. We've, looked a lot in Delaware. We just bought a project, bought a mall out in with a partner out in Long Island. That we're a minority position, and quite frankly, we're just an investor. They're going to try to reposition the mall and consolidate the retail and maybe do industrial in the future. But that's a very long-term play. We follow what's going on in the boroughs in the city. It's just it's crazy. We probably wouldn't expand into the city because it's just not a market we know. But what you're seeing, like Bridge Development is doing, I think it's a 5 or 6 story industrial facility out in I think it's in Brooklyn, which will be just a crazy new concept that a lot of developers are starting to try to figure out, because obviously you don't have a lot of ground space, but you have some vertical space. But yes, I mean, as e-commerce continues to grow and the demand for what we call last mile, same day delivery, these urban hubs will continue to need, kind of interior or internal warehouse facilities. But it's going to continue to grow, and it's going to be like this across the country. It's not just the Northeast. But great question.
Thank you.
Anything else? So I'll just kind of quickly, Loren, what do you think? Should we wrap up in like 5 minutes?
Sure. I was actually kind of curious. One of the things you were going to talk about was Lehigh Valley Flex Center,
Yeah.
which is right in front of one of my buildings. So
Yeah.
I was surprised when you guys did this. It was a nice looking building, but I see where the value is actually taking a building like this, tearing down a large office building, and actually putting up warehouse distribution in the same site.
Yeah, so this is a pretty interesting project. So this is it right here. It was the former headquarters for Guardian life insurance company. It was about 300,000 square feet, very obsolete. They actually built if you look kind of into the distance here, they actually built a new headquarters about half the size of this up the street. We were actually on it and walked from the deal. We were really having a tough time. Well, this was probably 4 years ago, buying this property. At the time, we were valuing it somewhere around like $18 a square foot for warehouse facilities. And I just said to Jim, I was like, geez, I don't know, Jim. I don't, I mean, that's like kind of top of the market. Now the land is worth $50 a square foot. So in 5 years, it's almost tripled in value. Based off of rents, obviously rents increasing. We were looking at, 5.25 rent. Now rents here are 7, maybe 7.25. And looking at cap rates around 6.5, and cap rates now 4.25. So we walked from the deal, and they went back out and marketed it. And then we had we sold another building. So we did a 1031 exchange, which is a tax deferral. So you take all your profits and value from one deal and you put it into another deal without paying taxes, basically. There's more to it. But so we bought this property and converted it into a 3-building. Let's see if we have a site plan here. No, we don't. This is it. If you see this lower part, I don't know if my cursor is working. We did a 3-building industrial park. We've completed 2 of the buildings to date. Both are leased. And the 3rd building will start in the spring, and we're pretty close to signing a lease for that. But it just goes to show that even experienced developers like us, 4 or 5 years ago, had no clue where the market was going. And quite frankly, nobody does. It's just there's too many variables and too many things that can happen, even with the pandemic. Sitting here probably a year ago today, remember I had a conversation with a broker about these 4-package deal we had on the market. And he was saying, listen, it's going to be great. You're going to do really well on it. And I said, well, what about this coronavirus that you're seeing over in China? He's like, that's going to go away. It's not even a problem. And a month later, the market shut down. So a month from there, nobody saw it. And then all of a sudden the market's completely shut down. So you just don't, I think if you're in the real estate investment side, you have to have sound investment strategy. You got to plan for the downside. Especially if you're a developer, you're using your own funds. You just have to be very careful in how you look at these projects. So we bought this at whatever it was. I think $18 a square foot. Tremendous value for us sitting here today. But even if the market came back down, we still have an asset that makes sense if the cap rates start to rise and rental rates go up.
And you're seeing in that location, by the way, there was a lot of office. This is Lehigh Valley Industrial Park 4. Office space, that park right now is almost 20% vacant, which is unfortunately quite high. But warehouse space, again, distribution is doing very well. So repositioning this particular site and a lot more industrials coming into this is changing a lot of this park over from that office type flex back to industrial warehouse.
Sure. And you're seeing a lot of this now. You're seeing a lot of old antiquated office buildings and malls being torn down for warehouse if you can get the approvals. This just so happens that the underlying zoning here permitted industrial warehouse facilities. However, they limit you on what you could put into these facilities. Like this wouldn't work for an Amazon because you're only allowed so many dock doors in a building. We were limited by trips, the amount of vehicles and things like that. So this for us, these buildings, the building up top is Stuff Puffs, which is a manufacturing facility for a food group that innovated the marshmallow market by injecting chocolate and peanut butter into marshmallows. So that's that building. The building down that's under construction in this picture is more of a warehouse facility, and the 3rd building looks like going to be more of a cold storage food distribution facility. I'll just kind of jump through these pretty quickly. So this project, Curtis Wright, was an LVIP 7 in Bethlehem. This is really pretty close to Lehigh. You can kind of see this from the 78 412 on and off ramps. This is more kind of prototypical what we do and hold in our portfolio. I forget the size. I think it's 160 or 180,000 square feet. It's a heavy manufacturing facility for Curtiss-Wright, that is a Department of Defense manufacturer. And it was a really great deal for us, 15-year lease. This is the type of tenant that's not moving. They've invested, 20, $30 million into this building. And it's something that they'll probably stay in for well past their current lease term. Let's see here. And then we do some kind of cool stuff. We bought this. This is by Lehigh too. This is called The Factory. It's right next to Steel Stacks. If you ever are down by the entertainment area. This was an old Bethlehem Steel building. You can see the before picture. We partnered with The Factory, which also owns Stuff Puffs, that we did the lease with, and converted it into this really cool kind of incubator space. And The Factory basically invests in small cap food, healthy food manufacturing businesses that are looking to grow, and they provide basically all the investment funds and kind of back office support for marketing and branding and things like that to grow these companies. And one of them was Stuff Puffs. This is more of a third-party construction deal we did recently for Moravian College. It was their health and science center. So again, the third-party construction side of our business is really important to us. It's kind of the lifeblood of the company. And I think if you're in real estate, the more streams of income you have, the better. So, we have the third-party construction side. We've got the institutional investment development side. We have our own kind of core portfolio. We have the multifamily side. We try to capitalize on as many different market segments as we can, because you just don't know when one market segment will have a downturn and others don't. So groups that are heavily weighted in retail right now are getting really hurt. And so for us, we have a retail center, but we can kind of muddle through it because we have a large industrial multifamily portfolio to help offset some of the loss there. This is our largest multifamily deal to date. This is a station at Willow Grove, which is in Willow Grove, Pennsylvania, right outside of Philadelphia. It's 275 units. It took us over 5 years to get this acquired. It was 20 lots that we had to assemble. It's a redevelopment zone, so get the approvals and then build it. It's 275 units, 30,000 square feet. 20,000 square feet of office space. And this is really kind of symbolic of what we do. You can see it was really antiquated, rundown area, developed this nice luxury apartment community that's now up and fully leased. This is a deal in Plainfield, New Jersey, which is actually another aspect of our business. We do affordable housing as well. So affordable housing, you don't make a lot of money in the development side, but you use financial incentives. In this case, it was low income tax credits that are given by the state of New Jersey to help build affordable housing complexes. And we actually own the industrial building, ABC Supply, next door. So really great aspect of how we do urban infill redevelopment, focus on the small industrial, and in this case, our affordable housing component of our business. We also do a lot of schools. And so this is another project that we did in Plainfield, New Jersey, for a charter school using another financial incentive called New Market Tax Credits to help support the development of the project. The other thing we like to do is when we invest in a community on one project, we try to do as many projects as we can in that community. Warminster, Pennsylvania is a great example. We've done, I don't know, probably 8 or 9 deals here. Mostly, I don't know if you see my cursor moving or not, but you can see the station at Bucks County, which was one of our first multifamily projects ever done. Jacksonville Station was another multifamily project. Then you have all these small industrial buildings that we've acquired around it. And we do have a retail center, our only retail center, up in the corner here. But most of our multifamily has been focused on being transit oriented along train stations in New Jersey and Pennsylvania. Not a big factor in today's market, but we do believe post pandemic, that these locations will be great for our residents to get to work and into more into cultural hubs. This is probably, I think this is the last slide. This is probably a microcosm of what now you're seeing in the market. Port Logistics Center is a 200-acre site that we bought in South Jersey 5 years ago, and figured it was a 20-year project for us, that we weren't going to develop it, but we had some again tax deferral money, bought this site and really sat on it. And all of a sudden, probably 2 years ago, you started to see the demand for space in South Jersey increase exponentially. So we went through the process of getting approval for 4 buildings. I don't think I have a site plan. Oh, I do. A 4-building industrial park, a 1 million square footer, and then more the 200,000 to 300,000 square feet. That's more in our portfolio size. The 1 million square footer today, we thought the value 2 or 3 years ago was $20, $30 a square foot. We're in the market now for an institutional partner, and we expect the value just for the land, we're talking just land, not the building, will probably be about $70 a square foot. So, just in a 2 or 3 year period of time, that's how quickly land values have increased today. That's it. That's all I got. Any questions?
Do you anticipate like the land prices will continue to rise going forward?
Yeah, so I guess the question is, will rents continue to rise? Because the cap rates can't, I don't know how they go lower, right? You're talking about cap rates getting down to close to the prime rate. And I don't know, Loren, if you know it, I don't know if cap rates have ever been lower than the prime rate has been. And that would be basically saying that,
Well, with some caveats, because we did see that in areas like San Francisco where people thought the growth rate was going to be astronomical. But with a few minor exceptions, no, they don't go that low.
Yeah. So, I guess the question is, will rents continue to rise? And the answer right now is they are. So, the South New Jersey market rents were probably in the $4.50 range 2 or 3 years ago. They're now projected to be in the $7 range. And the reason why South Jersey is doing so well is because there's no space available, or very little space available, in northern and central New Jersey. So the tenants are naturally moving south down the 95 corridor. And South Jersey has benefited just from the fact of the increased demand for space from users. So, yes, I think rents do continue to grow. I don't know at what rate, but we do think values will continue to increase slightly here.
Any other questions anybody's got?
You mentioned that as a developer, you guys take on a lot of risk, and it's important to have downside protection. What type of downside protection do you guys have to kind of reduce that risk?
Yeah, I would say, so we will look at the market. First of all, we would never buy land for $70 a square foot. It's just not, we'll buy it with a partner and maybe take a 5% interest in the deal and really mitigate risk, because you can make money on construction and development fees and things like that. So you don't have a lot of money in the deal. But So for us, we try to add, your cap rate depends, right? So the cap rates we're talking about to you are what's based off of final product, credit tenant in your building paying rent. So there's very little risk in that deal. You add more basis points at different aspects of the project. So for us to take speculative risk, if we think the market's at a 4 cap, we're valuing a project based off of, a 200 to 300 basis point spread. So if you remember when we went to this cost benefit analysis, it all goes back to, sorry, that was too fast. It all goes back to figuring out what your total cost is in a project. So how much is it going to cost me to get the approvals? How much is it going to cost us to build the project? How much downtime am I putting into leasing up the building? What are my rents? What do I think the value is? And then plugging in what we think we can pay for the land. The land is like the last number that you plug into that type of assessment. So for us, we're trying to buy things, at a 200 or 300 basis point spread above what we think the stabilized cap rate is.
Anybody else? I do want to thank you again. We really appreciate you taking the time to come on with us. This is somebody who's actually been through the development process hundreds of times all over the region and knows the business inside and out. So if you want to ask any questions, please take your opportunity to do that now.
How you said that you like delinquent tenants were much lower than you anticipated, but how have you dealt with that during COVID with governments restricting and holding rent payments?
Yeah, it's a great question. So there's a lot of different ways. We've asked all of our tenants that are delinquent to at least prove the burden that they've been impacted by COVID. So have they lost their job? Like, were they in the food service industry? Things like that. So if tenants are showing us that they're absolutely being impacted, we're working with them. We're putting them on payment plans. If they can't afford it, we're saying, listen, it is what it is, and we won't evict you during the moratorium. And at some point in time, when you get your job back, we'll start back up. Or if you leave, we'll not chase you for the money. Tenants that aren't not showing the burden of proof and are just trying to take advantage of the system, we're trying to file on them, so at least we're in queue to evict, or offering them settlements to move out of the facility. And anybody that has been impacted, depending on where you are, the various like counties and local governments have aid. So we try to send to give them all the information in filing for aid to help. But it is a difficult situation. I would say that a majority of the tenants are doing the right thing, and we're trying to do the right thing by them. But people that are clearly trying to take advantage of the system, we're not holding back on.
Thank you.
Great. All right, guys. Well, thanks.
What's the best piece of advice that you'd want to give to someone who wants to get into development?
Listen, I think early on, I would try all different things. The market's going to change. I actually, when I entered the market, I entered just before 2008, where for the industrial real estate market, and quite frankly, the real estate market in general, was devastating. So, I mean, I had just bought my first house, just married, and I didn't even know if I was going to have a job, because the market literally just imploded. So I would try all different aspects. The development side is great. It's very entrepreneurial. I never really kind of fit into kind of a big corporation type of mentality. And for me, this was great, but I worked at CBRE for a while. I think getting into these various programs, kind of like executive programs, whether it's with a lot of these bigger institutional groups have them, but getting to see other aspects of the business, because there's a lot of different aspects, and brokerage and capital markets is really important. And certainly, I think the biggest part is really trying to understand how do you underwrite a deal. And so understanding the financing side is definitely the basics is really important, but networking, getting out there, try your hand in a couple different things. There's, the real estate industry, there's not a clear path into it. My background was geology. So, I mean, I haven't used geology in 20 years. So, I think there's a lot of different aspects to it. But I think you focus on trying to get as much experience as you can in your 20s, and understand where you want to be, because the market's going to change, and you might decide, hey, I see an opportunity, and maybe then office is coming back, and I want to be on the office side of the equation. But network, it's the most important thing. It always is.
Very true.
Thanks so much.
All right, guys, I want to thank you very much for joining us today. Any last minute words of wisdom?
No. Good luck getting through this pandemic. Hopefully we're through it pretty soon. I know vaccines are rolling out. Hopefully you get to enjoy some of the college experience. Again, it's been tough, but keep an eye out on e-commerce. It's a forever evolving business. I think right now it's all kind of sunshine and rainbows, but I think we will see some consolidation here. And it will be very interesting in the next few years to see what happens, because I think the over speculation and the overvaluation that you're seeing in the market today, it just can't sustain itself.
Agreed. All right. Thank you very much. We'll close it out for today.
Great. Thanks for the opportunity.
Thanks for joining us.
Thanks. Appreciate it.
Thanks, guys.
Thank you.
Thank you.
Bye.
Thank you.
Thank you.